We've got 9 scheduled trading statements from FTSE 100 firms coming up in the week ahead, with another half dozen or so scheduled to host their annual general meetings for shareholders. Now, some of the most informative ones out of that lot could include the following. Full year results from Vodafone on Tuesday the 16th, finals from British Land and Utility SSE on the 17th, full year results from luxury goods firm Burberry, Land Securities and Royal Mail on Thursday the 18th, and last but not least, a trading statement from Hikma Pharmaceuticals on Friday the 19th. But for me, the corporate update which could really cause a fuss in the week ahead is the interim set of figures due from airline Easyjet on Tuesday the 16th of May. As we can see here, shares in the FTSE 100 member have forged a bit of a recovery after the hammering they took last year, from worries over Brexit and consumer confidence on one hand, and the increase in input costs caused by the falling pound and a soaring oil price on the other. The other line, in red by the way, is the oil price on that chart. Now, Easyjet's first quarter update back in January had a bit of a gloomy tint to it as well, as Chief Executive Caroline McCall commented, and I quote, "The pricing and operating environment remains tough, with fuel prices remaining low and continued strong growth in European short-haul capacity impacting yields across the industry." The boss then cut earnings expectations for the year by £35 million, citing fuel costs and the pound. Now that sets the stage for these first half figures. As you would expect, Easyjet is a seasonal business, and in 3 of the last 4 years it's actually made a loss in the first half. Last year the operating deficit was £24 million, so I guess that's your benchmark for next week's figures. This chart shows the sequential profit progression with the bars, while the line shows fuel as a percentage of sales. It was 26% a year ago and less than 23% in the second half of the last fiscal year, but oil firmed in the first half of this fiscal year after November's OPEC meeting in Vienna. Remember, Easyjet has a September year end. Other figures to watch are revenue per seat, which was £51.64 in Q1, down 1.2% year on year. Cost per seat, which rose 1.1% to just under £38 in Q1, despite a cost-cutting drive thanks to fuel. We'll also look at growth in non-seat revenue, such as food and shopping. That rose 19% in Q1, and finally load factor. That was 90% in Q1. Also keep an eye on any comments regarding Brexit and the EU Open Skies regime, as the company has been evaluating a continental base from which to claim an AOC, or Air Operator Certificate, so it can keep flying routes which don't touch the UK. That's around 30% of the business, and getting the AOC is likely to cost around £10 million. Finally, watch the net cash pile, which ended last year at £271 million. As we can see here, Easyjet actually cut its dividend very slightly last year, and it's expected to do so again this year to keep the payout ratio at around 50%. Easyjet hasn't traditionally paid an interim dividend, just a final, but keep an eye out for any comments here too. As a final point, the pound has begun to rally and oil has gone back below $50 a barrel since the end of Easyjet's first half, so the outlook statement could be informative. Both developments may give Caroline McCall something to smile about, even if there will be hedging there, after what's been a testing year for the firm and the travel industry overall, given events in Brussels, Munich, London and elsewhere. Thank you for watching, and I look forward to seeing you next time.